Does the conflict in the Middle East have you worried about your money? Well, today we're going to go over the most important chart you will see this week. Also, software stocks like Salesforce, Microsoft, and Intuit have been annihilated on fears of AI. We've got that topic covered and more. Let's dive into it. Now, before I get into the market update, just to thank you, we have crossed over 3,000 subscribers here. Our next goal is 5,000, and 86% of you are not subscribed. So hit the subscribe button, turn on the notifications. Thank you very much. Well, listen, a huge topic recently has been the conflict in the Middle East, and geopolitical issues, when they arise, are always scary. They're always a concern. We have a chart today, though, that really helps put into context what the impact of these geopolitical events are on the stock market. So what we're going to look at first takes a look at 13 conflicts that have taken place really since 1990. And what you see there, the name of the conflict, and then we're looking at what was the stock market's return 30 days later, 90 days later, and 1 year later. Because when the conflicts begin, typically the market goes down a lot on fears. But you can see, looking out 30 days later, and many of these events you'll recognize: the Gulf War, the World Trade Center bombing, 9/11, the Brexit vote, Russia invaded Ukraine, and the Israel-Iran conflict from last summer. And so looking out 30 days later, on average, the stock market is actually higher by 1.1%. If you go out 90 days, on average higher by 3.8%, and 1 year later up almost 13%. And by the way, I should add, the only two occasions where the market was negative 1 year later was the 9/11 attacks, which occurred in the middle of the dot-com bubble collapsing. There also was a recession soon after. WorldCom blew up. So the 9/11 attacks themselves weren't the reason for most of those declines. And then on the Russia-Ukraine invasion in 2022, the market was lower by 5% a year later. Most of that was because 2022 is when we had sky-high, out-of-control inflation, and the Fed was aggressively hiking interest rates. Notice in the last couple of years, the Russia-Ukraine conflict is still with us, and the market has done very well. So realistically, if you look at it this way, the market's been higher 12 months later in almost every one of these occasions. Now, the next chart we want to go over, we're looking at crude oil in 2025. This has a big impact on gasoline prices, and I'll draw your attention there to when oil was at $65 last summer. When the Iran conflict happened, then there were bombings during that time also. Oil shot higher, as you can see there, to $76 a barrel. But notice it did not stay there long. As soon as it was evident it was going to be a short-lived conflict, it came right back down and resumed its descent over the rest of the year. So listen, we think that's likely to be the case again this time. Oil has gone up. WTI is up at about $75 a barrel right now. And as soon as the conflict winds down, very likely heads lower once again. Now, the last chart we want to go over here is taking a look at where is the oil going that's going through the Strait of Hormuz. This is fear. If it's closed, what's going to happen? But this is interesting here. Almost 40% of that oil goes to China. So they're the big losers in the event that closing is happening. 15% is going to India, other Asian countries you can see there. And then you come around, the US is just at 3%. A lot of people don't know, but we are energy independent here, have been for a number of years. If this event had happened in the 70s or 80s, it would have had a much bigger impact on us, but that's not the case here. Next up, we're talking about software stocks. It has been a tech wreck for this group, and tech in general has not done well lately. In fact, in February, you will notice there lots of names that everyone knows. Amazon down 12%, Oracle down almost 12%, and you can see there down month for almost everyone except Netflix up at the top. Now, this continues a trend, and the fact is a lot of the software names have gotten hit hard on the idea that every time an AI model comes out from ChatGPT or Claude, the market sells these software names thinking, hey, companies are not going to need to pay these software names. They'll be able to do it with AI. Take a look at how far down, and this is over the last 6 months, how far today these stocks are trading off their high. Microsoft down 27%, Adobe, Salesforce, and you can work your way down to Datadog down 46%, Oracle down 56%. That is quite a beating they've taken. And then right under Oracle, the IGV, the software ETF that owns a lot of these names and more, down 30% from their high. So listen, here's what I think has taken place. There is this narrative right now that AI is going to be very damaging to these companies. This reminds me of last year at this time when all the tech stocks sold off on DeepSeek, China's AI model that came out, caused NVIDIA to take a major dive, and a lot of other tech names on a narrative that just wasn't true. In fact, we did a video and we said, don't believe everything you're reading here. Lo and behold, fast forward 4 to 6 months, and those names had not only made up the ground they had lost, they had all gone much, much higher. We think the same case can be made that will take place this time around. Now, the next thing we want to go that kind of backs that up, the narrative again is that software developers are all going to be laid off of these companies. We're looking at current employment for software developers, and this goes back to 2000. Notice it's consistently go higher, but take a look over the last year and a half, this has continued going up. This should be going the other way if it was really the case that there was not much need for software developers, but that's not happening. This is at an all-time high. Now, this is backward looking. This looks back a couple months. Let's look at real time, and this is job postings on Indeed for software developers. And again, take a look. This has been racing higher since the start of 2026, January and February, going up, up, up. More and more job openings out there for software developers. So listen, this doesn't match the narrative that has been out there. We've seen this many times over the years in the stock market. A narrative takes hold, stocks go up or down on it, and the narrative turns out not to be the case. We think that's going to be the case yet again here. Now it's time for rapid fire. And this is where we go over some key charts that we think you need to know about. And we're going to start off looking at earnings growth, comparing tech and the Mag 7, the biggest 7 tech stocks, to the rest of the S&P 500, the other 493. On the right-hand side, this was as of December 31st of 2025 in green. Expectations were for earnings growth year over year of 4.5% for the 493. Go over on the left, you can see it actually came in at nearly 10%, twice what was expected. That's pretty good. Go back to the right side in black. The Mag 7 growth was expected to be 20%. Back to the left side, growth came in at 27%. That is phenomenal growth. And this is one of the big reasons we don't think the tech run is over, because ultimately when these tech names are putting up that kind of growth, you just can't get that anywhere else. All right, next chart here. And this is looking at over time, going back to 1995, How has the average stock traded versus the stock market? And I just want to point out that right now, the average stock is bouncing around almost 7 times what the market is doing. Let me tell you what this means. That the market itself has not been moving up or down all that much over the last couple months. But beneath the surface, the average stock has. There has been wide dispersion. Some names are up 40, 50% year to date. There's some down 40 or 50% year to date. Every year that happens to some degree, but you can see this has skyrocketed. This right now is by far the biggest gap that we've seen over the last 30 years. The last chart we have today, and this is taking a look at inflation. Listen, everybody still feels inflation. The fact that over the last 5 years, prices are much higher now than they were pre-COVID. Well, this looks at between 2019 and 2025, what categories have had the most inflation. And you can see even the ones on the top that haven't been nearly as much as the ones on the bottom are pretty significant, over 20%. New cars and truck, milk, alcoholic beverage, housekeeping supplies, etc. As you work your way down though, rent of primary residence up 30%. We talk about housing and it's much more expensive. That's an example of it. Used cars and trucks up 33%. Electricity up 40%. That hits everybody hard. And then down near the bottom, car maintenance and repair, piped gas, utility cost, and lastly, oh, this hurts, car insurance up 56%. That's a category that just hurts us all, spending that kind of money on car insurance. So listen, those are a couple key charts for you to know about. So the key takeaway is that while the headlines are scary and what's happening in the Middle East is not good, it's not going to have a significant impact of most of the companies in your portfolio. And history says conflicts like these normally resolve with the markets higher even 30 days later. On tech, we talked about the software stocks have gotten wrecked, but there are some good bargains in there because the narrative just doesn't match what's happening on the ground. Well, listen, if you are new to Centera Capital, you can head on over to our website. We have newly redesigned it. We got some cool stuff there. And then you can go to the contact page and reach out to us and have a conversation. If you're not getting these kind of updates from your advisor, we'd love to talk to you. Thanks for watching and take care.